For today's video, let's talk about everything going on with Tesla and Elon Musk from the perspective of a Tesla shareholder, me. It's certainly no secret that Tesla stock is taking a beating, with its price down more than 60% year to date. But with the company continuing to perform exceptionally well, it's hard to imagine the market is devaluing Tesla on performance alone. In fact, much of what made Tesla's operations so attractive a year ago still remains today. So why are investors out on Tesla? Once upon a time, there was a man that fell in love, but not with someone, something. Earlier this year, Elon Musk expressed interest in buying Twitter for a price of $43 billion, an offer that would pay stockholders $54.20 a share. But to many, Twitter wasn't exactly a great investment. Twitter has long struggled with turning a profit, and it was never because they couldn't find ways to monetize, but because their competitors like Facebook were more attractive destinations for ad dollars. Twitter may be a great platform, but it lacked the reach of other big tech players. The first thing that came to mind when I read Elon wanted to buy Twitter was why. Twitter had its issues, but I was more so questioning the move to take on yet another large business venture. Elon isn't just running Tesla, but also SpaceX, The Boring Company, and many other projects. Genius or not, we all have the same 24 hours, and for Tesla shareholders, an hour worked on Twitter is an hour not worked on Tesla. Then I started thinking about the price tag. $44 billion is a ridiculous amount of money for an individual to come up with, and yes, even for the richest man on earth. Sure, I expected Elon to bring in other investors to fund the deal, but no matter what, he was going to have to convert a significant portion of his wealth into cash. And what's the problem with that? Most of Elon's wealth comes from one source: Tesla stock. When details around the $44 billion deal surfaced, it was revealed that $13 billion would be financed through debt, with the remaining amount financed through equity. From other investors, Elon was able to raise roughly $7 billion. Combine that with Elon's small ownership position in Twitter worth $4 billion, and there's about a $20 billion hole that needed to be filled by Elon or other investors. The bulk of that $20 billion ended up being financed through the sale of Tesla shares, hitting the company's stock price. And hey, Elon had every right to liquidate his shares whenever and for whatever. But as a shareholder, you don't want to see the founder and CEO selling off big chunks of his ownership. The reason is that ownership is what aligns incentives with all other shareholders. Elon does what's best for Tesla. Why? Because it's in his self-interest to do so. I don't expect Elon Musk to make decisions on whether Alex with the YouTube channel is happy, but I do expect him to make decisions that benefit himself. The more ownership he sells off, the less his self-interest aligns with shareholders. So Elon's offer was just too good to turn down, and Twitter quickly accepted the buyout. That $54.20 a share was a very nice premium for stockholders. It just made sense. In a classic example of buyer's remorse, Elon brought up concerns about Twitter's users being bots, and Twitter's transparency on just how much bot activity there was. This called into question the integrity of the buyout, and ultimately, Elon wanted out. I can't lie to you, I was relieved. The deal falling through was best for Tesla. But you know what? If someone offered me $44 billion, entered a legal contract that guaranteed that offer, and then told me never mind, you bet I'm fighting for that deal. And that's exactly what Twitter did. Long story short, after some legal action, the deal was enforced, Elon officially bought Twitter, and took the platform private. All this back and forth on the deal covered Tesla with uncertainty. And the one thing investors hate is uncertainty. So Tesla stock entered an extremely volatile environment where there were more questions than answers. A volatile environment opens the doors for a particularly savage group of beings: short sellers. Tesla has long been a short seller favorite, but this time it wasn't about doubting Tesla's production capabilities or demand levels. It was about Twitter. And the thing about short sellers, they can make ginormous moves in stock prices big enough to spook those Tesla investors on the fence into selling their shares, further pushing the stock price down. So we're at the point Elon owns Twitter. He starts making immediate changes to the company's workforce and platform features, and then opened himself to something much more volatile than business deals. He allowed himself to be politicized. Now, Elon has always been an outspoken figure, but since the Twitter acquisition, he's become a full-blown chess piece in the battle of left versus right. So, how does that hurt Tesla investors? Well, one of the things that has made Tesla so formidable in the EV space is its branding. And although some companies have successfully embraced a political identity, politics are an extremely divisive topic. Elon risks alienating segments of Tesla's customer base if Tesla's brand becomes characterized as divisive. To support Tesla is to support something controversial. Prior to the Twitter acquisition, Tesla's brand was centered around innovative technology and eco-friendly luxury headed towards widespread availability. Now, I'm worried recent events will detract from those focal points. Branding is everything. It's that connection between company and customer. Branding is loyalty, and not everyone wants to be loyal to controversy. All of this thus far has made Tesla stock incredibly sensitive to even the smallest news reports. We just saw how an uncorroborated report of slowing demand in Asia resulted in the stock price plummeting. Until Tesla can reaffirm to investors that it's business as usual, that price sensitivity will continue. Most recently, Elon sold another bucket of Tesla shares valued at almost $4 billion. That brings his total Tesla liquidations to nearly $30 billion. And as I said before, the more he sells, the less his interests align with shareholders. The reason for that sale was not disclosed, but there's speculation it has to do with the high interest debt Elon took on to finance the Twitter deal. One thing I failed to mention, which admittedly has huge implications, the debt may be restructured to be collateralized by Tesla stock. This could be easily the single worst thing for Tesla investors, and here's why. If the debt is backed by Tesla stock, chances are the loan structure is some form of margin loan. For those unfamiliar, margin loans are simply borrowing money against owned assets. But margin loans entail what are called margin calls. If the assets serving as collateral fall in value by a certain amount, the lender will call for more money to be delivered as additional collateral. So everything I've mentioned that's caused Tesla's stock price to plummet would also trigger margin calls. But here's the worst part about this. To meet those margin calls, Elon has to sell more Tesla stock. And when word of that reaches the public, Tesla's stock price will fall further, sparking more margin calls, and so on, and so on, and so on. Where do we go from here? Well, I can't say for sure. No one knows what the future will bring, but I will say what I'm hoping for. First, believe it or not, I hope Elon can successfully turn around Twitter. Elon owns Twitter. No use crying over spilled milk. If he can turn it around, hopefully, he'll take the company public again and use those proceeds to inject capital into Tesla. The debt will be repaid, and Tesla stock will no longer be collateral for billions of dollars of loans. Second, I hope Elon pulls back from the controversial spotlight. As long as he's CEO of Tesla, anything he says and does will impact shareholders. Whether that's creating more volatility in the markets or impacting Tesla's brand, sometimes, when it comes to the public stage, less is more. This one might be coming to fruition. At the time of filming this, Elon posted a Twitter poll asking if he should step down as CEO of Twitter. It appears the majority says yes. And third, I hope Tesla continues to focus on what makes it exceptional, its operation. Tesla reaches levels of efficiency that other automakers just aren't capable of achieving, at least not yet. Tesla's manufacturing and production are second to none in the industry, but it's important that they continue to scale and innovate. Other automakers are catching up to Tesla by capturing certain segments of the EV market, offering cheaper alternatives, and more variety. With that said, Tesla's financial trends are those of a promising company with extreme growth potential, and the EV industry is still in its infancy. If they can stay the course, investors will no doubt be rewarded. So, the Tesla situation from a Tesla shareholder. It's been one hell of a headache, and it's not over. While filming this, Tesla has fallen another 6%, and there's the ever-looming threat of recession. But I'm optimistic. I still see a great company lost in the shadow of controversy, and obviously, I believe in the long-term success of Tesla. Their brand may be impacted by what's going on, but Tesla is still synonymous with EV. I think the lesson here is that owning individual stocks can be exhausting. It takes some serious emotional fortitude, and sometimes the risk just isn't worth the reward. And that's all I have for today's video. As always, thank you for watching. Until next time, take care of yourself, and best of luck. Oh, and before you go, I can't believe I forgot to say this. If I don't see you again this week, Merry Christmas and Happy Holidays.